Hello, everyone. This is Calvin Russell, CEO and founder of 850 Club Credit. Hope everyone's doing well today. Today, we're going to talk to you guys about what factors actually affect your credit score in 2022 and beyond. Let's go ahead and get started with this. So many of you may have seen or know these numbers, have seen this type of chart or knowing what your factors are. But some people aren't 100% sure, or they don't know necessarily what that means. And I want to kind of break that down. Okay. So as we know, 35%, which is the largest percentage of what makes your score, comes from payment history. And that simply means you want to make sure that everything is paid on time. Now, on time does not necessarily have to be on the actual due date. It can be anything that's less than 30 days late. Now, obviously, you don't want to be late, but some things happen. So if a bill is due on the 1st and you pay it on the 1st, then obviously you're on time. If a bill is due on the 1st, but let's say you pay it on the 10th, not only will you maybe charged the past due fee, by the creditor or whatever the case may be. But that's just one thing that can happen. The other thing of it is that you are late, but you're not late to the credit bureaus. Credit bureaus consider an account being late or a late payment being 30 days late or more. That said, as long as you're less than 30 days late, you are quote unquote on time. Okay. So that's payment history. The next biggest percentage or factor that affects your credit score, that creates your credit score essentially, is going to be utilization. 30% of your score comes from utilization. Utilization is the balance divided by the limit. This is in regards to revolving lines of credit only. So if you don't have any revolving lines, which most people normally do, then of course this wouldn't factor into it. Or if you don't have anything open, this wouldn't factor into it. The history from that would. But most people typically have a revolving line of credit. That's where what you owe or what you owe, can change. You can swipe your card and you can owe more. You can pay down a balance. You don't have to necessarily, you may not be using the card right now. It could be a zero balance. Whatever that is, you have the balance divided by the limit. So for example, if the limit is $1,000 and the balance is $250, then that's at 25%. As you're taking $250 dividing it by 1,000, that's going to give you 25% utilization. The utilization that you want to kind of stay in is about 10 to 30%. You can have it at 0%, but you obviously want to be using your credit cards. I always recommend, putting things on auto pay. That way you can show low usage and obviously on time payment history at the same time. So of course, if your utilization is still high, if your utilization is high, now all you have to do is just pay it down or ask for a credit limit increase. You can also get another credit card and do a balance transfer as well. Okay. It goes by your total utilization. So for example, if you have two credit cards, one with $1,000 limit and one with a $500 limit, your total utilization limit is $1,500. And then of course your total balances would be your total balances. So you add up the balances, you add up the limits, you'll still divide the balances by the limit. That'll give you your overall utilization. Again, you want to keep that under 30%. And it just so happens that it makes 30% of what your score it factors from anyway. All right. Then 15% of what makes your credit comes actually from length of credit history. That's how long you had an account open. But again, it's all of your accounts. So if you have 5 accounts and they all have been open for 1 year, then that means your average credit length history is 1 year. Okay. The reason why that's important is because you may be, doing things very well, but now the catch is how long can you do it? So usually that's where scores start to get really stagnant after 730, 740, 750, simply because when you need, from 750 and beyond, you more so need more time than activity. It's more so how long can you stay positive. The same is true on the other side. Obviously, if you go in the other direction, if you want to get a score under 500, it's how long can you be negative, right? How long can you keep doing derogatory things, right, with your credit? So same thing, same rule is going to apply. Long story short, you want to keep accounts open that as long as possible. Obviously, things like, most loans have expiration dates. Most, of those, personal loans, student loans, mortgage loans, auto loans, they're going to have an expiration date, obviously. So as long as you, pay those off, you don't have to stretch those out. Anytime you're extending those out, the exact same loan, that means you're not making payments on time. Now, if you refinance, that doesn't necessarily mean that you're taking that loan and stretching it out, because they're going to close that loan out and then just open up a new loan. But that will affect your average length of credit length history. A good history is anywhere between 5 to 8 years. 8 to 11 years is needed to even get to 850. So you need to have certain things in place. That way you are, keeping the accounts open as long as you possibly can. And the only ones that you can really do that on is going to be revolving accounts. 10% of your credit is going to come from new credit. Okay. So, and of course, another 10% is going to come from credit mix. So let's break that down. So, new credit obviously is how many new accounts you're going to be opening. You don't want to open up too many accounts, obviously, because of what I just said moments ago about the average age of credit. Okay. So, you just want to, pick a few accounts and have them open. So if you want to have, 3 to 5 credit cards, 5 to 7 credit cards, that's up to you. But obviously, you won't really see the benefit of them until you start keeping them for, 5 to 8 years, 8 to 11 years. Same thing with a credit mix. That's usually going to naturally happen, simply because everybody kind of starts off with the credit card, and then they may have a few other credit cards, but that's just a very small mix, not because of the amount, but mainly because of the account type. So you want to get revolving accounts along with having along with having installment loans, and that's going to be obviously personal loans, student loans, mortgage loans, auto loans. You don't have to force yourself to do these things, but these are things that kind of just naturally happen over time. Once you decide, hey, I want to go ahead and get a car, I want to go ahead and consider getting a home, and that will be a good mix. You don't have to force yourself to get personal loans. Obviously, you don't have to force yourself to get student loans. But that mix is going to just naturally happen over time. But that's essentially the 5 factors that make up your credit score. So if you like this video, like it, you want to share it, and as always, be sure to subscribe, as we have nothing but great content well on the way. Thank you guys so much. Have a great day.